Hello, everyone. It's Monday, January 13th, and this is John Voss. I just wanted to thank you for attending our presentation of how to place an options trade. We are going to have a live Q&A during the event. If you would, please post your questions in the chat, and I'll be glad to address each one of those. This webinar is going to focus on how to buy a call or how to buy a put. And we're going to use our Expiration Week Countdown recommendations that came out last night. These calls and puts are going to be held 5 days or less, and they all expire this upcoming Friday on January 17th. Now, for these purposes, we're going to be using the Schwab platform, but many other of the various platforms will operate similarly. So let's dive right in. Our first recommendation we have is for Carvana. And Carvana, the trading team would like us to buy the 192.50 strike put. So they believe that Carvana stock is going to be going down during the course of the week. So we're going to look at the different variables that go into placing an options trade. So you'll see it's obviously very important to pay attention to the ticker as well as the action. These are all long calls and puts. So we are going to be buying to open to enter the trades. And then when we go to exit our positions, we are going to be selling to close. Then we are also going to need to pay, obviously, attention to, are we buying a call or are we buying a put? And with Carvana, we're buying a put. And of course, we need to pay attention to expiration. As we said, all these expire January 17th. And we also typically will always use limit orders. However, the expiration week countdown is a bit different. We are going to use market orders provided the stock is trading within the optimal entry zone. If the stock's trading within the optimal entry zone, then we know it is a viable trade. So let's go into Schwab and place our Carvana put. So for the ticker, we're going to put in CVNA and select Carvana. Then for our strategy, we're going to select put. So now when we enter these 6 positions, we want to select the action as buy to open. So for simplicity purposes, the quantity is going to be 1, but just know when you read through the handbook on Expiration Week Countdown, we would like for you to follow our money management discipline, which is essentially to use a consistent percentage of your available capital into each of the 6 positions. So here we want to make sure that we select the proper expiration of January 17th, this upcoming Friday. And then we want to select the strike of 192.50. So let's select the strike. There we go. And we have a put. So let's verify that the stock is trading within the OEZ or optimal entry zone. Right now it's at 191.20. And they said it's good as long as it's between 187.50 and 200. So this is a good trade. Looks like the bid is somewhere in the neighborhood of 605. Ask is 665. Here, our order type, we're going to choose market. So our order is going to fill at the prevailing price, typically at the ask, in the neighborhood of 655. So then we want to go in and review our order. Confirm we want to buy to open one contract of Carvana, January 17th, 192.50 put at market price. Good for the day. So with the time in force of day, it's going to fill right away because it's a market order. So let's say we get filled at 6:55. The trading team wants us to set our target profit at 300%. Now, 300% is quadruple our cost basis of 655. So if you take 655 times 4, our ideal exit point would be $26.20. So then we would go in and place a stop order at 26.20 to automatically trigger our sell to close so that we can take our profits. Let me show you what that looks like. Let's go back into our Schwab platform, and we're going to select Trade Options, and we're going to put our information back in. Carvana. We're going to select our put, and our action is going to be sell to close. And then for quantity, since we purchased one contract, our quantity will remain consistent at 1. Our expiration will remain consistent at January 17th, as will our strike of 192.50. Now, our order type is going to be limit. And we're going to designate our limit price at 26.20. And our timing is going to be good till canceled. So with all brokerage platforms, your GTC order for the option will match the expiration date that you selected of January 17th. So this means that if our put contract goes up to 26.20, that our limit order will automatically trigger and close it out. So here, after you put in all the information, then click Review Order, and then Place Order. Of course, I cannot place the order because I didn't place the entry order to begin with. So now, let's go look at our second recommendation. What do they have here for us? Dollar General. This is a put as well. So we believe that Dollar General is going to go down in value between now and Friday. And as the stock price decreases, the value of our put contract will increase. And again, they want us to set a target profit of 300% or a quadruple multiplier of our cost basis. Now here, our optimal entry zone is going to be anywhere between $69.50 to $72. So much, much tighter zone. Let's take a look. Let's go into our Schwab platform, select Trade, select Options. Now we need to put in our ticker of DG and then select Dollar General from the dropdown. Then I'd like you to select the strategy is put. There we go. Now for our action, as we go to enter the position, we want to select buy to open. Now we're going to let the default of one contract be used. Our expiration for all 6 positions is January 17th. And the strike they recommended was $72. So let's adjust our strike to 72, and then we have our put. So again, with a long put, just remember we are buying the ability to sell 100 shares of Dollar General at the agreed upon strike price of $72 to someone, or put those shares to someone between now and January 17th. The bid is 194, the ask is 208, and let's confirm that the stock is within the optimal entry zone. Right now, it's trading at $70.80. Well, there we are within the optimal entry zone, 69.50 to 72. So it's a good trade. So let's go back into our order type. And remember, for all of these, we want to select market. And we know it's going to automatically default today. It's going to fill at the prevailing price. And it's going to cost us somewhere in the neighborhood of $207 per contract. So you want to select review order, confirm all the information is correct, buy to open, $1 general, January 17th, 72 strike put at market. And our ask, oh my goodness, it's moving around quite a bit. But here we have our price somewhere in the neighborhood of, let's say, 213. So we would place our order, and then we would go back and place our stop order at 4 times our cost basis of 213, which would be $8.52. So let's go back, place our Dollar General put, and we're going to select sell to close. We bought one contract, so we're going to sell one contract. Our expiration remains consistent at January 17th. Our strike has to remain consistent at $72. And we have our put, and we're going to designate our limit order at $8.52. And our timing is going to be good till canceled, which means at any time between now and Friday the 17th, if our put contract goes up to 852, it'll automatically trigger our order and close it out. Yes, that is correct, Terry. That's a very good question. Are good till cancel orders open until I close them? I have only used a day limit order before. Yes, so they will stay open until they expire. But you can always go in and remove your limit order there to sell to close. So let's look at our next recommendation for GE Verona. Here, they would like us to buy the 365 strike call for this Friday. And we want to be able to place the trade as long as GE Verona is trading in the neighborhood of 354 to 374. Let's take a look. Let's go into trade, select options, and our ticker is GEV. GE Verona, there we go. And again, we're buying a call. So know that when we buy a call, we're buying the ability to buy 100 shares of the stock at any time between now and Friday at the agreed upon strike price of $365. So the expiration is January 17th. Strike is 365. We have the call. We know the bid is 660. The ask is 730. So let's make sure that we're within the optimal entry zone. They told us anywhere between 354 to 374 is acceptable. And right now it's at 361.68. So it's good. So now we want to make sure that we have our buy to open, one contract of GE Verona, January 17th, 365 strike call, and our order type is market. And it's going to run us, oh goodness, about 740. So here we're going to select review order, and it's moving all around, but we should be able to get filled. They're thinking somewhere in the neighborhood around 710, and then select place order. So using 710 as our cost basis, we want to go back in and set our stop order at 4 times. So 710 times 4, 2840. That would be good. Let's go in, trade options. Our symbol again, GEV. Select GE Verona. We bought a call, so we want to place our stop order. The action we're going to select is sell to close. One contract for January 17th, the strike of 365, and the call. And it's very important for our limit price to be set at 2840. And the timing is GTC, good till canceled, anytime between now and Friday the 17th. If our 365 call goes up to 2840, our pending order will automatically trigger and close it out for $2,840. Let's see, what's our next recommendation? Ooh, Halliburton. They want us to buy the 27 strike put. And they want us to buy the put as long as the stock is trading within the range of 26 to 27.50. So let's go see how the lay of the land looks here. Let's put in our ticker, HAL, Halliburton. And they want us to buy the put. And our action is buy to open, one contract, January 17th. Our strike is $27, and it's a put. And it's looking like it's going to run us somewhere in the neighborhood around 46 cents per contract. So let's go into our order type and place a market order. Again, for using our money management discipline, with this premium being much cheaper than the others, you would want to use our fixed fractional bet system to allocate a similar dollar amount to all 6 of the positions. So here we verify our order, review order, buy to open, one Halliburton, January 17th, 27.50 put at market. And let's see, here the stock is trading at 27.65. So it is ever so slightly over and above our optimal entry zone of 27.50. So what they would recommend is that you keep an eye on it, but don't place the order right now. Even though it's only over a little bit, just know that if you did decide to make that decision to purchase that put on Halliburton, you might have a situation where it would eat into your profits or it would exacerbate your losses. So your best bet is to keep an eye on the Halliburton stock today. Wait till it drops back down to be within the optimal entry zone of 26 to 27.50, then place your market order. Oh, let's see. We have a question here. Should I place these trades before the market opens or wait a little into the trading session for better pricing? We recommend, since we're using market orders, you want to wait for the session to open so that you can verify the stock is trading within the proper optimal entry zone. Sometimes in the morning, especially on Monday mornings, you could have a large gap up or large gap down to where they're well outside the zone, and the trading team does not recommend that we chase those types of positions. So let's look at Palo Alto Networks, our fifth recommendation. And here they want us to buy the 172.50 call. And they give us the optimal entry zone of 167.50 to 177.50. So that seems reasonable. Let's go in and see what it's trading at now. Select trade and select options. And the ticker for Palo Alto Networks is PANW. There we go. And here we are buying a call. And our action is buy to open. One contract, January 17th. And they want us to buy the 172.50 call. So we're going to select 172.50. Now, if you take a look at this, the stock is down $6.62 on the day. So the stock is trading at 166.80. Let's see what the zone is. 166.80 is outside of the optimal entry zone. So here, we would like you to keep an eye on it. And if it goes back in the zone, it might be worthwhile. However, with a significant drop like that, it may be more difficult to achieve a profit on the trade. So keep in mind the 172.50 call. This would be out of the money because the stock price at 166.80 is below the strike price of 172.50 on our call. So that would need to come back up considerably in order to be a profitable trade. Let's take a look at our last recommendation, Roblox. They want us to buy the 62 strike call at 300% profit target, as long as it's trading between $61 and $63. Let's take a look. Our ticker is RBLX. And they want us to buy the call. So our action is buy to open. One contract, January 17th. And they gave us the strike of $62. Let's choose that from the drop down. And our 62 strike call is trading in the neighborhood of 55 to 59 cents, but the stock is down $1.64 on the session here in the lunch hour. So it's trading at $60.17, which is outside of the optimal entry zone. So again, even though it's just slightly outside, they would not recommend placing a market order at this time. So keep an eye on it, and maybe later in the session, the stock might go back to within the zone and then be considered a viable trade. Okay, so I hope everyone is enjoying going over all of the different variables that go into placing the options trade with our ticker and action and strategy, and especially our strike and expiration. And I know a lot of our clients like going in and having the ability to place those limit orders for our profit target. So, does anyone have any other questions before we sign off today? Okay, so it looks like we are in good shape. We again will make this link available for anyone that would like to review it, or if you have any questions, please give us a call at 1-800-448-2080, and we'll be glad to help in anywhere possible. And again, I'd like to thank you all for your time, and I hope you have a great day.